Good morning to all traders, and today we are looking at USD CADs. There is a massive anomaly playing out right now. The Canadian dollar, which is of course highly correlated with crude oil, because Canada is a major exporter, um, is not really strong currently. We see USD CAD moving towards the 140 level, with the geopolitical crisis pushing oil well over the 100 barrel, well, at least Brent. And WTI currently is around 92, 93, if not mistaken. Someone would naturally expect the Loonie to surge, but USD CAD is trading higher, and it's it could be heading towards 139.20, let's just say 27.30, whatever that top is, which is a short-term double top at this channel that we identified as flag last time we looked at USD CAD. So it all comes down to the interest rate differential and the safe haven dominance of the US dollar. Currently, the Fed sits at 3.75, but the BOC it's at 225. Okay, so this 1.5% premium is what makes the US dollar far more attractive for current traders. On top of that, Canada's latest inflation print came in surprisingly soft at just 1.8, while the US is seeing hotter energy driven inflation, with the chances, of course, of a potential hike also increasing. So, even though rising oil prices are a fundamental tailwind for Canada, the combination of safe haven flows through into the US dollar and the wide interest rate gap is completely overriding the oil factor in the short term, at least. But if we jump into the daily chart and we look at technicals, there is potential for a stronger Canadian dollar against the US counterparts. Since our last review, the pair broke outside the bearish flag. And importantly, what has happened since is that we have had a five-wave leg to the downside that ended, at least for the time being, this particular bearish impulse, because you have had five-wave down here and then five-wave down here. Obviously, this is in a much shorter, smaller degree. Let's just change this to minor, let's say, so on the daily. So you see, we currently either trade in a correction, which would essentially um, continue to the downside with further bearish sort of movement, or we might have actually gotten a medium to long term bottom in, which would suggest perhaps prices are going towards the 50% FIBO, which is exactly at the peak that we saw back in November at around 141.50. The 50% Fibonacci, let's not forget, is also where sentiment changes. Okay, so it's important to pay attention to that level in case we break above 139.30. So 139.30 is our very important major level. Below that, in the shorter term, we also have the low that we saw back in October, which brings us to around 139, I would say. Okay, so short term 139, short term also, but above that is at 139.30. So these two levels are very important to pay attention to the upside, especially as we are very close to RSI being overbought. And if we look at previous attempts for the RSI to actually go overbought, they haven't really managed to do so. So there is potential here in the short term that we go and retest either of these two levels, but this essentially becomes a sell zone. We're also going to have a double top in the medium term if we can move the way up to 139.30, which would or could suggest that this might be a consolidation. Okay, all of that territory, which would essentially bring us initially down to the previous high at 137.50, which is a major support to the downside, but as well as exposing the bottom at 135.89, 4, 89, excuse me. If we came all the way down there, it's either we go back up and we break higher, or we just bounce and then move lower down. If we bounce and we move lower down, it would actually indicate potentially a double top over here. Okay. Now, the game plan. Because momentum is stretched and we're approaching major resistance, this is setting up as a sell the rally opportunity for me. So we said we need to watch these two critical resistance levels. Okay. If price rejects here, we could form a short-term trigger for further downside. The absolute line in the sand is the 139.30 for me. It is highly unlikely we break at least before we fall, right? Above that level, because the RSI really going into the 80 territories would be closer to an event that we saw back in December 24. If we see a rejection at either of these levels, then the first downside target, major downside target, is the 137.50. So just simply by these structural levels and these marks that we've placed on the chart, if we look at a potential short-term short at the 138.90 with a stop just above the previous high, okay, and a first target at 137.50, we've got a 2.5 risk reward ratio, which is a very good opportunity. It doesn't necessarily mean the war escalates. It could be something else. However, the way I see it on the macro landscape, there is a lot of talks about pausing attacks on energy infrastructure of Iran, trying to push a potential deal um, to Iran. So all of these things could actually act as a catalyst. We could surprise this drop in this case all the way up, back down to test the 135. Hold on. That would be actually all the way back to 134.85. Okay. But as long as price remains below that level, yeah, that is a sell zone. If we do break above that territory, that this could essentially mean that the bottom is in and we're off to 139.82 and then 141.36, which again, I repeat, was a double top over here. Now, the longer term to the upside brings us to 142.90. The longer term to the downside uh, could, as I said before, suggest that we might just be doing the first wave of a correction and then we're going to continue lower that. Way more bearish implications. But if we just want to quickly check where we are in terms of that corrective leg, we just broke above the 50 and the 61.8, it's not magically, sits at the same exactly level that we have actually marked around 138.83. Okay, so this is going to be a very important cluster for me, which will be looking to go into a short-term trade. So take care, and I'll see you in the next video.